Hello everyone, and thank you for attending this presentation on the one chart pattern that can make you successful. Hello and welcome once again. My name is Primo, and I am the president and founder of Specialist Trading. And for those of you who are unfamiliar with our website, I see we have a very large crowd today, so that's great. But I know we have a lot of new members coming in today. So if you're unfamiliar with our website, we are first and foremost an educational company. I know there are a lot of companies out there that promise the world and give you trading strategies and signals and stuff. Well, we do that as well, but we're really focusing on educating you so that you can empower yourself. I've been trading actually for 37 years, and I was a floor trader on the floor of the Pacific Stock Exchange. I was a specialist on the floor, and hence that's where we get the name Specialist Trading. I left the floor in the mid-90s to pursue my own trading to manage money, and I've traded just about every market imaginable around, from the Forex to the Eminis to stock market. And when I formed Specialist Trading, my focus was on teaching and empowering the people the same things that were able to make my trading consistent. So all the things that I've accumulated in my 37 years, I teach and mentor to my students. So as I stated, we are an educational company. Even though we provide you with strategies, with all the rules to trade with, we give you tips and techniques that I've accumulated and pretty much my personal mentoring. We're more about educating you than just simply blindly taking signals that we produce for you on a nightly basis. All right, with that said, why don't we just take a few moments to look at our disclaimer here. We're required to show you this. I'm going to show you a lot of performance results using this number one chart pattern, but please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So as you're taking a moment to view our disclaimer, I know we have a lot of new people in attendance today, so for those of you who are new to my presentations, you'll know that I like to give a lot of attention to detail. I love to teach and make sure that you understand what I'm trying to teach you in these presentations, and therefore I like to keep the questions to the very end. I know a lot of you may have questions while we're in the full mode of the presentation, but many times if you wait for the next slide, your questions will be answered. So if you happen to have a question and it's not answered in the presentation, just kindly write it down, and we'll reserve the last 10 or 15 minutes for any questions. And if you'd like to rather speak to someone live, I will furnish you with an email address or a phone number where you can contact us and you can actually ask any question you'd like. So once again, if you just happen to come into the presentation, wait till the end to ask any questions. Also, another question that's probably asked the most out of anything is, are these presentations recorded? So I'll answer that right off the bat, yes they are, and at the very end I'll give you the email address where you can ask and we shall send you the link. Okay? Now, I'd also like to mention that you can now follow us on Twitter. We just started this roughly about a month ago, and what we do is we provide you with information, tips, and techniques as we see fit. Now, for the members of Specialist Trading, the students and members, the full-fledged members, you get signals as they happen in real time. In other words, if there is a signal the night before, such as there was for us to go long the Emini a couple of days ago, and the markets, you would have received that the night before, where to enter and where to exit. Whereas on Twitter, we will post that after we are in the trade, and we won't exactly tell you all the information. But you're free to follow us on Twitter at SPCLSTTRADG. All right, now as I stated, we are an educational company. And why do I focus and stress so much about education? Well, contrary to what most people believe, even though I was trading on the floor, I had a very difficult time trading. I know a lot of people think that as a floor trader and as a specialist, you have no room at all to lose. You're always just making money, and that's not true. My first year or two, I couldn't make a dime. I was really struggling because I was probably trading about 99.9% of the way all traders trade, and that was basically trying to pick tops and bottoms. I was trying to pick a bottom during the crash. I was also trying to pick a top when the market was taking off in the 90s, and many times, it would work, but it was that one time where I didn't pick the top or bottom, and I'd give everything back. So my mentors, who were traders on the floor as well, taught me certain things that were able to get my trading on board and that was able to make me consistent. And they taught me that, Steve, it's not about hitting home runs, because there were tons of traders on the floor who made hundreds of thousands of dollars, if not millions of dollars, in just a matter of weeks or months, but then they lost it all. So it's not about how much money you're making. I know you want to make money and provide for your family and be abundant, and that's great. But the way to get there is through consistency. And so that's what they taught me. They taught me how to trade with consistency so that you can be trading 20, 30, 40 years down the road. See, it doesn't matter if you're trading and you hit the jackpot and then 5 years from now you're busted and you have no more money to trade with. So what matters is that you have a technique or some type of method that will give you that longevity, that will sustain you through all the different market environments, and that you'll be able to trade down the road. And so that's what we teach, and that's what my goal is. The same teachings and the same things that were taught to me that were able to sustain my trading, that's what we teach in our courses. All the tips and techniques I've accumulated in 37 years, so hopefully we can shorten your learning curve so you won't have to be trading for 37 years in order to get on that road to consistency. Now, what my mentors taught me is what trading should be, because as I stated, I was really struggling. I just couldn't make ends meet. Every time I had a really good month, I would give it all away. Or even a good 3 or 4 months, I'd give it all away in 1 or 2 trades. So here's what my mentors taught me about trading. They said, Steve, trading should be non-subjective. Well, what does this mean? It doesn't mean that you shouldn't have some insight into the trade or have some feeling as to what you think is going to happen, but it means that if you get a signal, if your strategy or method or what you're determining your entry on provides you with a signal, 2 people should be able to come up with the same definitive answer. In other words, if you hear some news, everyone should be able to say, well, it's positive. But that's not the way trading usually is. Most times where people have methods or techniques where someone can look at that and say, that's very positive. And you take someone else, another trader, and say, no, that's negative. So trading shouldn't be that subjective. There are too many things that people are trading with that are open for discretion. There's just too much discretion. There's too much subjectivity. So it should be more cut and dry so that when everyone looks at a pattern or a technique or an indicator, they should all get the same response. They should all say, yes, you should be buying, yes, you should be selling, or yes, you should be out of the market at this time and on the sidelines. They also said trading should be consistent. Once again, most people are more interested in hitting that home run. They want that jackpot. And that should not, I repeat, that should not be your goal. Your goal should be consistency, which is 2 steps forward, 1 step back. So regardless of what all these different presenters say or websites say, oh, we have something that produced returns of over 200 or 300%. I would personally run away from that because you're not looking for home runs. What you're looking for is something that just consistently generates a nice gain each and every year, because that's what's going to sustain you. Remember, I told you nearly all the traders I was trading with on the floor are no longer trading. There's probably only out of about 500 people, maybe only 3 to 5 traders continue trading because everyone else has been wiped out. So it's not about some fantastic method that promises to make you $100 million in the first year. It's more about a method that will say you will trade 2 steps forward, 1 step back, but you will be able to trade 20, 30, 40 years down the road. And then lastly, my mentors taught me that said, Steve, this is the most important thing and probably the most difficult thing for novices or beginning traders to understand, but trading should be as simple as possible. And I thought, well, as simple as possible. I looked at my trading plan, and I had maybe 10 or 15 rules on what my decision process was. I was looking at probably 20 or 30 indicators on my screen. I was subscribing to every news service. I was listening and looking at every news, plus I was listening to what other people were telling me. And my trading was extremely complicated. And what my mentors taught me was they said, Steve, it's the easiest thing in the world to overcomplicate your trading. Anyone can do that. Anyone trading for 2 days can do that. But it's the most serious, or it's the most difficult thing to really seriously simplify your trading. Not everyone can do that. Now, if you look at traders who have been trading for 3 or 5 years, the way I was when I first started, trading was tremendously, their trading plans are tremendously overcomplicated. They're not simple at all. They have tons of rules and they're very difficult to follow the plan. Whereas if you look at people that have been trading 20, 30 years, most of their trading plans have maybe 3 to 4 or 5 rules at most, maybe looking at one indicator, perhaps not even looking at an indicator at all. So these are the guys that have stood the test of time. They have longevity and a plan that will sustain them, and most of them are extremely, extremely simple. And you're going to be surprised today when I share with you some of the information today, how simple it is, but how consistent it is. So as I stated, when I first started, this was probably the most difficult hurdle to get over, trying to keep my trading simple. But once I was able to do that, and I really mean simple, I'm not saying, well, have simple ideas, but no, simple plans, very simple things that you would probably heard a million times over and just glossed over. Once you keep it simple, you'll get on that road to consistency. All right, so why don't we begin? And as I stated, I know we have a lot of people today. Some people may have just joined us. If you just came into the presentation, remember, keep any questions till the very end. I'm not going to open up, there's a specific box I have to open up to review any questions, and I'm not even going to open that up, so I won't even see a question if you happen to ask one. So please just wait till the end to ask any questions, and I promise I'll get through each and every one of them, and I'll give you an email address or a phone number if you want to speak to us live. But also, yes, this is being recorded. Probably the most common question we get is, I have to leave early, will this be recorded? Yes, it is. Just use the email address or the phone number, and we will send you the link. Okay, so why don't we begin? And as I stated right off the bat, we are an educational company, so here's what you're going to learn today. I'm teaching you this like as if you were in a class, and you can start using and applying this information as early as tomorrow if you'd like. But I please always suggest to everyone to paper trade first. Don't just go out blindly and start applying this and think that you have it all down. It takes a little practice to make sure you understand the process fully. So here's what you're going to learn today. I'm going to teach you the truth about formation patterns, okay? A lot of people use them in their trading. I'm also going to teach you the truth about candlestick patterns, okay? A lot of traders, especially Forex traders, love to use candlesticks. And then I'm going to share with you the one chart pattern that, in my opinion, can make you successful, okay? Extremely simple, but in my opinion, this chart pattern has helped me become successful, and by successful, I mean consistent. All right, so let's start looking at formation patterns. A lot of traders love to look at formation patterns. The first one we're going to look at here is the ascending triangle. This is a bullish pattern from what they say, because what we're looking at here is we see the top line drawn and the ascending line. This has a ascending triangle or ascending wedge look to it. So you have this upward movement. You hit some type of resistance. You come down, you make a lower low. You hit that same upward resistance, you make another lower low, and then when you ultimately break through, it should be a very nice bullish move to the upside, okay? That's the conventional wisdom of ascending triangle. The descending triangle is just the opposite. It's the same concept, but just turned upside down. You have a downward move, you hit some type of support, we move up but make a lower high, you come down to that support once again, you move upwards again and make another lower high, and then when you ultimately break through to the downside, you should have a very strong downward move, okay? This is conventional wisdom with descending triangles. The ascending wedge is very similar. Once again, you have this nice upward move, and if you draw the outside line and the median line, it creates this kind of upward wedge. Now, this is a very negative pattern because conventional wisdom holds that once we break, such as right here, the movement should be very sharp to the downside. And then lastly, we have a descending wedge. The same thing, just upside down. We have a strong move downward, followed by a midline that, once again, you have to discern, and a lower line. And then this wedge is heading to the downside, but once it's broken to the upside, the method states that it should have a nice upward move. Now, all this is all well and fine after the fact, because, once again, it's very hard to discern in real time. It's very difficult. Someone could look at this chart and say, oh, no, you have a double bottom. Someone could look at it and say, no, it's a descending wedge. Someone could say, I don't see anything. So there's no way to have any clear-cut answer for this. It's very great when you look after the fact and you can decide it. Now, there are some people that are able to see this, but it's very difficult for them to teach how they see it. So we want something that's cut and dry. Here's another example. Probably the #1 chart pattern that people use and probably misuse is the head and shoulders. Now, this is just a common three-top type of formation where this first top is referred to as the left shoulder. You have a higher top, which is referred to as the head, followed by a right shoulder, okay, a lower top. So you have this kind of baseline right here. Once we have broken that, we are supposed to head lower, okay? Seems very simple when you look at the rules, but once again, it's too discretionary. It's too subjective. Let me show you what I mean here. Here's a chart. Doesn't matter what this is. If it's a 5-minute chart, if it's a Forex or stocks, it all follows the same principle. We have a very nice move up here, and then we've come down. All of a sudden, you look at your training and you say, boy, I went to that presentation, and this guy was teaching me about head and shoulders. And guess what? I think I see a head and shoulders right here. Here is the left shoulder, followed by a complex head, and here is a small right shoulder. So we just broke the baseline here, the neckline. We should have a really nice sell-off. So you'll sell, okay, based off of what you've been taught and what you've learned. And guess what? You go in and short at the market, and it goes higher. So you get stopped out with a loss. You think, wow, what did I do wrong? And then you look at the chart again after these few weeks where you lost money, and you said, you know what? I jumped the gun because now it's starting to go down lower. And guess what? This is the real chart pattern. We have a shoulder, a complex head, and this was the complex right shoulder. So now we have this really clear-cut head and shoulders. I should sell here, and now we're really going to go lower. So you sell once again, and guess what happens? You see, it's not cut and dry. Obviously, nothing is going to work 100% of the time, but we want, charting patterns that are going to have a little bit more probability for success. How about support and resistance? This is another thing that a lot of people use. Another term for this is supply and demand. In other words, we have this perfect case scenario here with an ascending chart, a nice uptrend. When you meet this resistance, this is basically just too much supply. People are selling. You come down to support, and then the demand comes up again. You have more supply here or resistance. We come down to support, and so on. So this is a nice, perfect scenario for support and resistance. So conventional wisdom just states that if you come down to the support level, it's based off of some measurement, either Fibonacci or some type of retracement level or some type of tool to help you know when you are at the support level again, maybe some great indicator you're looking at, and you should purchase at these support levels and sell at these resistant levels. Okay? Looks great on paper, but if we actually apply it in real time, it's like when I used to trade. It would work until it stopped working, and then I would give everything back. Here's a perfect example where we have a chart that looks perfect here. We have support, we meet resistance, we have support again, we have resistance. So once it comes down to the support, this is where you want to buy once again. So you jump in, and guess what? It goes a little lower. Well, maybe this wasn't the valid support, but this should be the valid support right here. So you jump in and purchase at this level, and guess what? It goes even lower. All right? I'm sure this looks familiar to a lot of you. I'm sure this has happened to you. I know firsthand this has happened to me in the past before because I used to try and trade off support and resistance, and it would work until it stopped working. Why? Because it was too subjective. Okay? One trader's support is another trader's resistance. How about candlestick patterns? Okay, these are great. We in fact have strategies that are based off candlestick patterns. So I'm not going to put down candlestick patterns and say you shouldn't use them. The only trouble is most people, in my opinion, misuse candlesticks. They use them improperly. Here's a perfect example. These are the most common candlestick patterns that people use, anything from a doji to an evening star. But I would say the most popular and most common pattern is the engulfing pattern. Very simple to use. Usually gives you the kind of a reversal type of feel or pattern, whatever you're looking at. So if we look at a chart right here and we're studying it, we've studied our candlesticks, we see that we have a bullish engulfing pattern right here. We've read all the text, we've looked at all the books and the webinars, and we've taken the classes and paid for the seminars, and we see that this is very positive. We should go long on this based off this bullish engulfing pattern. So you jump in and buy, and it goes straight down. Okay? Once again, it's not clear cut. It's not. It's a little bit too subjective, and at the same time, you are not having any consistency to this because you're using it incorrectly. So remember, my mentors taught me that your trading should be non-subjective, meaning that sure you should have 20-30% used for insight, meaning that when you see certain conditions, you will change your plan so that you can maybe trade more aggressively or more conservatively. But in other words, it shouldn't be that subjective where you're second-guessing your method because you're not sure if you should be going long or short. It takes some type of interpretation, such as a news event. You should never come to that point in your trading because basically you're just saying, I don't know. I know first example because I used to trade that way. Now, your trading should also be consistent. Remember, once again, you don't want to go for the home run. Sure, you will get home runs from time to time. Every once in a while, we hit these great home runs at specialist trading, but that's not our goal. We're not trying to go for the home runs. We're just trying to go for these nice, consistent trades. And then lastly, and most importantly, it should be as simple as possible. You shouldn't have 101 rules. You shouldn't have 20 million indicators. You shouldn't be listening to all these news sources or be involved in 10, 20 trading rooms or chat rooms. It's silly. It's just you're just too much overload of information, and you're just overcomplicating things. For some reason, you've been taught that that will make you successful, but it's actually the opposite. The more you keep things as simple as possible, that's where you'll be more successful on that road to consistency. So let me just share with you, these are the things that changed and turned my way of trading around. This is what I would love for you to do with your trading. Even if you don't become a member of Specialist Trading, you should go back and have a serious look at your trading plan and ask yourself, is it non-subjective? Is it consistent? And is it as simple as can be? So this brings us to the title of this today's presentation. What is the one chart pattern that can make you successful? Remember, we talked about simplicity. Remember, we talked about consistency, and we talked about being non-subjective. Well, here's the one chart pattern, and this is it. Regardless if this is a 5-minute chart, a 1-minute chart, or a monthly chart, you want to see a bar close in its top 25%. And when you do find a bar closing in the top 25%, that is an indication to buy. If you see a bar, regardless of time frame, regardless of market, close in the bottom 25% of its range. When we say range, we mean from top to bottom, not from open to close or from open to intraday points. We just mean from high, very high to very low. If we close in the bottom 25%, meaning you cut this bar into 4 equal but separate spots, the bottom quarter, you want to see the close somewhere in there. You want to look to sell because the market is giving you an indication to sell. I know you're going to say, boy, that's it. I attended this webinar just for this information. This is too simple. Well, we have to ask ourselves, why is this chart pattern, as simple as it is, why is it so successful? And this is probably the most important thing you'll see and hear today. You may want to write this down, but remember this is being recorded. But we look for things outside of ourselves in the markets to give us the answer. We're always looking for some trading room or some chat room or some trading guru to tell us whether to go long or short, excuse me, or for some system to give us the green light or the red light. But the most important thing you should be listening to is the market itself, the chart right in front of you. Because when a price bar closes either at or near the top or bottom of its range, it's giving you, the market is giving you, not an outside source, but the market is giving you a clue as to which direction it wants to go. I mean, what better source can you have than that from the actual market itself? It is basically screaming to you, guess what? I'm most likely going to continue in this direction. All right, so that's the most important tool I could have, rather than some formation that takes me weeks to fill out and then kind of have to come up with an idea. Is this positive or negative, or some indicator, or some candlestick pattern? It's easier just to look at this price bar because that's telling me everything I need to know. All right, so how do we apply this? How are we going to implement this chart pattern? Because, you know, this is not a strategy in it by itself. We have to put some type of plan together. Well, the good news is that you can apply this to any strategy. I don't care if your strategy is based off the full moon or it's based off news, whatever it's based off of. If your strategy gives you a buy signal, use this chart pattern either as an entry bar or once you're in the trade as a directional tool. In other words, it's giving you a signpost as to which direction the market wants to keep going. All right. So in other words, if let's say your strategy is based off news, okay, and you discern that the news is good, all the pieces of the puzzle come together that it's positive. Rather than just buy at the market, wait till you see a bar closing in the top 25% of its range in order for you to enter. Okay? Same thing if you're going short, whatever your strategy is based off of. Excuse me. If your strategy gives you a sell signal, rather than just sell at the market, wait for a bar that closes in the bottom 25% of its range. Okay? You may have to wait for a while, and if it never happens, chances are your strategy is not going to work. It's not going to head in your direction. So wait for a bar to close in the bottom 25%, and that's your entry bar. That's your signal to go in short, or you can continue to use it as a directional tool, in other words, as a signpost telling you where you should go. All right, so let's look at some examples here in stocks and see how this could have worked. All right, these are going to be some older examples, but we're there for educational purposes so you can understand these concepts. Then at the end of the presentation, I'll show you some more common examples where they happen as early as just a few days ago. All right, here's a chart of Tiffany. As we see here, looking back in hindsight, we've been going up in this chart, okay? But what if we wanted to use some type of pullback strategy, meaning that we had a nice upward move, and then every time we had a little sell-off, we wanted to get in. But where will we get in? How do we know when to get in on this little sell-off before it goes back up again? Well, we simply look for the bars that close in the top 25%. You look right here. You see all the signposts that the market was telling you that, guess what? We're not going to head lower. We're most likely going to go higher. And then we went up another 7 points. Now, at this point, we had a sell-off, a little pullback, because the overall trend is still up. We find all this confluence of bars that close in the top 25%, telling us we're most likely going higher. We go up another 3 points. Then we have another sell-off here, followed by a bar that closes in the top 25%, We go up another 3 points. And then another sell-off here. At this point, you could have said, well, that's probably it. We're probably going much lower. But guess what? We have these bars here telling us we're most likely headed higher. We go up another 4 points. Okay? Now, remember, this is not a full-fledged strategy. I'm just showing you how you can apply this to a strategy. All right? We're just showing you the most important chart pattern that can help you be on the right side or be in sync with the market. How about going to the downside? All right, we want to use some type of strategy to go short. Same thing. We're either using some type of pullback or some type of consolidation because we're in a clear-cut downtrend. Well, we see here that we went sideways. We consolidated sideways, had a nice bar that closed in the bottom 25%, and went 2 points lower. Then we go sideways to higher again. We have another bar. That's your signal to enter, 1.5 points lower. We kind of move up here to sideways, another bar on the bottom 25%, down 1.5 points. And then we have a really strong consolidation. Someone would think, well, we're bottoming out, but look at all of these bars that close in the bottom 25%. You see the clue that the market was giving you? Someone could have looked at this and said, well, this is a real strong bottom here. We are most likely bottoming out in ABX and we're going to go higher. Whereas you now, as a savvy trader, would say, not really. It's more clear-cut than that. I see a lot of bars closing in the bottom 25%. That's telling me we're going lower. And when someone would say, well, why do you think it's going lower? You said, because the market is giving me a clue as to which direction it wants to go. And guess what? We went 6 points lower after that. Same concept of working the E-mini. We want to look at an intraday chart on a 1,000 tick bar chart. According to our proprietary tool to discern what the overall trend is, we share this and we teach this at Specialist Trading. It says that we're in an up market. Okay, so we're looking for these little sell-offs, and then we'll look for the bar that closes in the top 25% right here. You see on the sell-off here, we never had a bar close there except for right here, and then look what happened. 4 points to the upside. Another sell-off. Here's the first bar that closes at the top of its range. Another 2 points to the upside. Here's the sell-off. Another bar on the top of its range. Another point to the upside. We have another sell-off. We have the bar that closes in the top of its range. Another point, and so on. You see this all the time, whether you're buying on a daily bar chart or a 1,000 tick bar chart or a 5-minute chart. The market is heading lower. We see a bar closing in the bottom of its range. We go down 2 points. Now we have a little bounce here. Someone could say, well, we've bottomed out. We made a really nice bottom. But you now are looking for the bars that close in the bottom 25%. And we go down 6 more points. We have another bounce here. Here's a bar that closes in the bottom of its range. Down another 3 points. And then lastly, the Forex markets. All right, these markets trend tremendously, so you'll see a lot more of these. Here's the dollar-yen, as we've discerned, in a very strong uptrend. As we see here, we sold off. Here's our bar that closes in the top 25%, up 300 pips, or $3,000 per contract. Sell off again. Here's the bar in the top 25%, 400 pips. Another sell off, another bar on the top of its range, another 200 pips, and then lastly another sell-off. There's the bar in the top of its range, 400 pips. See, as long as you're in sync with the overall trend, you're going to be looking for bars that close in the top of its range since the overall trend is upward. But if the overall trend is downward, such as the Australian dollar, you're only looking for bars that close in the bottom 25% of their range, such as you see here. On this little bounce, someone could have said, well, it looks like we bottomed out. Not really. The overall trend is down. And the first bar that closes in the bottom of its range or close to the bottom of its range is your signal to go short. That's $2,000 per contract. Another bar here, another $4,000, and so on. And this just doesn't work for daily bars. You're going to see this work in any time frame. Here's a weekly chart of the dollar Swiss franc. Look at all the bars here on those sell-offs that told you, gave you clues that on a weekly basis the market was going higher in the Swiss franc. How about a monthly chart of the euro-yen? This was a monthly chart a while back to 2008. It was in a clear-cut downtrend. All right, so we're looking for bars that close in the bottom 25% of its range. The entire time the market is giving you clues as to which direction it wants to go in. How about a 60-minute chart of the Australian dollar? We're in a downtrend. Look at all the bars that close, giving you clues on that pullback when it's time to get back in short. All right, so let's recap. We talked about the truth about formation patterns. There's nothing wrong with them. I know some traders who make tremendous amounts using formation patterns. The only thing is they're too subjective. So you have to have either this insight or this hidden chart where you can visualize and know exactly what these patterns are. Most of us can't do it. I know I can't. They're too subjective. I can see one chart and think it's bullish. Another one can see it and think it's bearish. So we don't want to be subjective. Another thing is the truth about candlestick patterns. Once again, we have nothing at Specialist Trading against candlestick patterns. We have a few strategies that employ them. So we like candlestick patterns. The only trouble is most people use them incorrectly. So they've taken away the consistency out of them. Remember, we want something that's consistent. We have a strategy for using candlesticks for the Forex markets that has consistently generated gains of 60%, going back roughly 3 years. So this is what we're talking about. We want this 2 steps back, 2 steps forward, 1 step back approach. All right. Most people are looking for the big score. We're not concerned with that. We're just looking for something that gives us a nice level of consistency. And then lastly, we share with you the #1 chart pattern that, in our opinion, can make you successful. Why can it make you successful? Because it's consistent. Because you're getting this information from the most important source we believe you should get information from, and that's the market. And too many people, too many traders lose because they take themselves out of the game. They either rely too much on some trading guru, some trading platform, or some trading chat room where they get all their signals from them, and they just don't have any say. So they've completely not become a part of the process. They take themselves out of the game, and then when it doesn't work, they don't understand why. They just continue to try and mimic what their trader is doing, and they continue to lose money. So we want you to be a part of the process, and the way to do that is by listening only to the market and not an outside source. Remember, we're an educational company. We have strategies that have all the pieces of the puzzle put together. They have all the rules. We have all the exits and entries. But our whole goal is to teach you. Our whole goal, as we state here, is to teach you, not to just blindly take our signals, but to teach you how to trade with the Specialist Edge so that ultimately you won't have to rely on any outside source. You won't have to rely on our signals that we generate and email to you. You can just simply see them for yourself and know exactly how to trade it according to your own trading plan. Now, the one thing I want you all to remember is that, as I stated, I shared with you this charting pattern today, but it is not, I repeat, this is not a strategy. It is just a very important piece of the puzzle. But that's all it is. It's just a piece of the puzzle. In order to have a full-fledged strategy, you need to have, a stop placement. You need to know about exit points. You need to know about entry points. You need to know about money management. So remember, this is just a very important piece of the puzzle that can make up a strategy. But it's best used either as an entry bar or a directional tool. So even if you decide not to become a member of Specialist Trading, you can apply this to your strategy. But by all means, go ahead. So whatever your strategy is based off of, all we're saying is that if you get a buy signal, just don't buy until you see a bar close in the top 25%, okay? Or if you get a sell signal, same thing, don't sell until you see a bar close in the bottom 25%. Now remember, this can be applied to any time frame, whether you're a 5-minute trader or a monthly trader, any direction, whether you're buying or selling, and any market. Doesn't matter. We showed you all the stocks, all the E-minis, and all the Forex examples. One tip and point to remember is that the higher or lower the close, the better the pattern. So even though it's okay to close in the top 25%, if it closes at the very high, that's even a better sign. You have a higher probability. Now, if I could just take just a few minutes before we go to the question and answers, I want to share with you a great strategy, probably our most popular and consistent strategy for trading just virtually all of the markets, and that's strategy number 4. And the best thing about strategy number 4 is that it employs this #1 chart pattern that we shared with you today. This is a great strategy. It works for stocks, ETFs, E-mini, and Forex. So if you become a member, you can apply this to virtually any market that you trade in any time frame. Let me show you some examples here. Let's show you an older example first of why we don't pay attention to outside sources such as the news. Going back to this past year in the summer, in July, news came out that Facebook shares jumped 28% because Wall Street sees more ad growth. It says here that Facebook Inc. shares opened 28% higher on Thursday after the company reported a huge jump in mobile advertising revenue. So this is great news. Boy, if you were waiting to get on board the Facebook bandwagon and you were waiting for the stock to finally do what you thought it was originally going to do after the IPO, this was great news to get on board and to jump in. So if we look at the chart here, this is when the news came out. Well, if you were a member of Specialist Trading and a member of the Strategy number 4 course, you would have actually gotten in 4 days earlier to that news, because on the 22nd of July, we generated a buy signal in Facebook, roughly about 8 to 10 points lower than when the news came out. So this is why we say listen to the market and not an outside source. Now, if we look at the spiders, which are an ETF on the S&P 500 index, we see here that looking back through November and right up until last week, or this past week, we generated 4 buy signals using daily bars in the spiders. Now, you could have used these as a directional indicator or tool to go long the market, or you could have actually purchased a stock or options on this if you wanted to. But these were all successful signals, all to go long. And as you can see here, we went long, all of our members went long off the signal based on the 14th. Now, let's go back to just this Monday when the market fell out of bed over 100 points. The market had one of its worst losses of the year, or I should say the worst loss of the past year. We were down 100 or 200 points. Well, if we look at a tick bar chart for those intraday traders of the Emini, these were actual sell signals generated using strategy number 4. Okay? So you think you could have done well if you're an intraday trader. Remember, it doesn't matter if the market's going up or down. This strategy roughly has about 4 or 5 rules. It's very simple and very easy to understand. And then lastly, for the Forex traders here, we can go to a weekly chart, a longer-term chart of the dollar-yen. The dollar-yen is in an overall uptrend, and look at the 3 signals we've gotten since past April, all to go long. You think you would have gotten long or wanted to get long the dollar-yen here? Each one of these would have generated, as you see, these hash marks are each roughly about $2,000. So as you can see here, look how well you would have done off of all of these signals. Probably a minimum of a $2,000 to $3,000 gain. So once again, in closing here, I want to invite you all to become members of strategy number 4. It incorporates the number 1 chart pattern. So in other words, this is just not some throwaway webinar or presentation that we wanted to share something with you that's kind of a neat tool. No, we actually use this in strategy number 4. It's one of the pieces of the puzzle, one of the rules to generate buy and sell signals. Now, if you want to become a member of strategy number 4, I really suggest that you take advantage of this fantastic deal we're giving you because you're an attendee to our webinars. This course is usually very discounted down to $695, or we're discounting it even more for all the attendees down to $495. But this is for a limited time only. Now, if you decide to become a member, you get instant course access. You don't have to wait for anything to be mailed to you. Detailed instruction with 5 videos. We tell you all the entries, exits, and stops. We give you signal alerts on daily bar charts so you know in advance, such as I just showed you with the spiders, where you would have gotten long and short. Weekly video trading lessons are archived for you to enhance your trading. This also includes the free add-on. This is the add-on that you can upload to your charts that will generate the buy and sell arrows so that you'll know as a learning format where the buy and sell signals are. And you can apply this to intraday trading or weekly or monthly trading if you like. And then finally, access to my personal email address. You can contact me with questions anytime you like. This is tremendously discounted at $695, where we're dropping it even more down to $495. And if you're an intraday trader, if you saw that last chart I showed with the Emini from Monday, you could have just with one contract paid for the course many times over if you had taken all those signals. Okay, so this is a great discount. You get all the learning and expertise from me. You can contact me through email, and you will probably be able to start getting the rules as early as this afternoon. So if you want more information, you can go to our sister site, which is Pro Trader Strategies. They market and sell all of our individual strategies. And if you want to speak to someone or you want to email someone, you can contact our trading reps at trading@protraderstrategies.com, or you can call us directly at area code 310-598-6677. Now, I want to thank you all for waiting. I know we probably have some questions, so if you'll just give me a second here to open up the question and answer box, I'll start taking this. And as I stated right off the bat, is this seminar recorded? Yes, it is. That's the most common question we get. And just contact us through the email or through the phone, and we will send you the link to all of our discounts and also to this recording as well. Let's see. Can you send a link to the oh, this is someone asking for the actual link. Someone said they came in late. What was the pattern? This is Bill. Okay, Bill, I don't want to backtrack all the way because I don't know where that exact page is, but here's what the pattern is. It's a 1 bar. It doesn't matter if it's a 5-minute bar, and it does not matter if it's a monthly bar. But if you are in an upward mode and you're looking for a buy, or say your strategy generates a buy signal, you will only want to enter the market once you see a bar that closes in the top 25% of its range. So let's just say that bar is, for all intents and purposes, to make things easy, 4 bars in length. From top to bottom, I mean 4 points in length. From top to bottom, 4 points in range. You just want to divide it in equal subdivisions of 1 point. So you want to close in the top 25%, anywhere in that top quarter of the range of that bar from top to bottom. And then that is your signal to enter the market. Let's say your strategy gives you a sell signal. All right. Rather than what most people do is place a limit order or buy at the sell at the market, what you want to do is find a bar that closes in the bottom 25% of its range. So just take the range from top to bottom, okay, divide it by 4 separate but equal parts, and you want to close in that bottom quarter of its range. And if you have a close there, then that is your signal to enter. But wait for that. And why are we waiting for that? Because the market is giving you a clue that it's most likely continuing in that direction. And that's probably the greatest clue you could get from the market. I mean, how would you like to know if something is telling you that it's going to be going in this direction, or if a horse will tell you that it's most likely going to win? Now, I'm not going to promise you that everything is going to work out 100% of the time, but this is a very consistent, high probability clue. In fact, you can go right now, go back and look at any chart that you were trading today or something you had a position in, and look at the times it closes in the top 25% of its range, and if it continued in the next 5 or 10 bars in that direction, and vice versa. So this is incorporated in strategy number 4. Okay, we're not just sharing with you something that's kind of a throwaway idea. This is actually used in strategy number 4. And once you get the rules, you'll see all of the other rules applied for entry, for stop placement, and for exits. Okay. The Metastock add-in comes with I'm sorry, Dennis is asking, the Metastock add-on, will it come with an Explorer? And as you see here, yes, it currently comes with Explorer as well in Metastock and Radar Screen in TradeStation. So what you can do is, for people who aren't familiar with that, it's just simply a tool that is in Metastock and in TradeStation where you can incorporate, and it will scan looking for all the signals for that day using strategy number 4. So it's a great, great tool to use that way. So at the end of the day, you can come home and scan, use the Explorer, or you can use the Radar Screen, and it will scan and find all these setups using strategy number 4. Okay? So it's a fantastic deal. As we stated, as you just saw using the intraday chart, you could have paid for the course many times over for you and all your family and friends if you had just taken the signals on that day using one contract. Even though we're not going to promise that, it's just a tremendous, tremendous discount at $4.95. Okay? So we're really trying to empower you so that ultimately you'll be able to spot all these signals in whatever market you're trading and just be able to take the signals and feel confident and trade them at your own level. In other words, you can trade them conservatively or aggressively, and we teach you all this in the course. Now, a lot of people are asking, like, well, where's the exit? Remember, this is what comes with the course. We can't give away all of this for free. It wouldn't be fair for the people that spent $6.95, the full price, to give away all of the entries and exits and stop placement for free in a free presentation. So in order to get that proprietary information, we advise that you become members, and you'll be able to be trading with this right away. Okay? All right, if there are no further questions, I just want to thank you all for attending. Remember to take advantage of that limited time offer with strategy number 4. I personally use it. I was using it today. It's a great, fantastic strategy to use. One of the first strategies that I started using when I was on the floor once my mentors taught me about this, and it's a fantastic way to trade. I look forward to all of you attending my presentations, and I look forward to all of you becoming future members of Specialist Trading. Thank you so much. We'll see you next time. Bye-bye.